Good morning, students. Welcome back to the session on Ind AS. Today we'll continue with our discussion on business combinations. In the last session, we were discussing about exceptions in relation to certain items which are not necessarily which do not get recorded at the fair valuation, or which do not get recorded at the time of business combination accounting, or which at times may get recorded or may not get recorded. Yeah. So which was all about exceptions related to the recognition principle, and the exceptions related to the measurement principle, and the exceptions related to both recognition and measurement principles. So I'll just take you to those points once again, and I'm just hoping that you have come with revision of all of these points. So we were able to discuss most of these points about share-based payments, about indemnification assets, contingent liabilities, assets held for sale, employee benefits, all of them, except a couple of points related to income taxes and reacquired rights. Yeah. So today we'll continue with these 2 points first of all, and then we'll move on to the next part related to business combinations. Yeah. We are actually now talking about the PP exercise, that is purchase price allocation, or in other words, you can also say the accounting which is required to be done on the date of acquisition by the acquirer. Correct? Yeah. So let's now understand about income taxes. Now, what's the exception around income tax? As we all know, that at the time of business combination, fair valuation of assets and liabilities is required to be done. So let's understand this way. So we have purchase consideration from which we reduce fair value of net assets. And this, let's suppose, was 1,000. This, let's suppose, was 700. Correct? Now, another principle on income taxes, that means Ind AS 12 requires that whenever there is a temporary difference, okay, whenever there is a temporary difference, that needs to be recognized. Now, at the time of business combination, these assets and liabilities which get recorded at fair value other than goodwill will also or may also have temporary differences. Yes or no? Yeah. So the temporary differences on these assets or liabilities will require recognition of deferred tax on above net assets. So the deferred tax which arises on these net assets will also get recorded over here. Yeah, and then we get the goodwill amount. For the time being, I'm just keeping intangible assets away because you can assume that intangible assets are also covered here. Okay. The most important point for us to understand is that deferred tax is getting recorded, and this is another item which is getting captured for the computation of goodwill, and now goodwill will be the balancing figure after considering the deferred tax assets or the liabilities, whatever be the case, and whatever be the number. Let's suppose this is 100. Okay, yeah, let's suppose this comes out to 100. Now, in this case, the deferred tax that we recognize and measure is done as per the requirements of Ind AS 12. And this deferred tax is not fair valued. This is not the fair value of the deferred tax. How is it recognized? As per the principles given under Ind AS 12, which is not fair value. That's why, what do we say? That's why we say that deferred tax becomes an exception to the recognition and measurement principles. Clear? All of you? Yeah? Simple and easy to understand. Another exception wherein the fair value is not getting captured. Yeah. So Anjali, I'm hoping that this is now visible on the board. Jay, can you please check if there is any problem? Jay, can you please check? Yes. Sorry, I forgot to remove the presentation at that time. Yeah. So I was talking about purchase consideration, that is 1,000, from which we reduce the fair value of the net assets. And on these net assets, we also recognize deferred tax. And this deferred tax does not meet the definition of fair value. Why? Because this deferred tax is recognized as per Ind AS 12. All right. Because this is recognized as per Ind AS 12, that's why what do we say? It's an exception to the recognition and measurement principles. And the resultant amount is, of course, goodwill. And again, just repeating this point because the board was not clearly visible at that time, that I'm just excluding some of the components of which I have considered earlier, like for example, intangible assets for the time being. Okay. That doesn't mean it will not be required to be considered. For the time being, I've just kept it away because our idea is to understand about this deferred tax, which gets recorded at a measurement using the measurement principle other than fair value. Okay, now clear on this? I'm hoping all of this is visible now. Anjali, it's all fine. All of you clear? Yeah. Okay, now moving on to the next exception. Reacquired rights. Now, what is a reacquired right? Let's suppose there's a contract between acquirer and acquiree prior to the business combination transaction. Okay, wherein acquirer has given certain rights, means intangible assets, to the acquiree to be used, let's suppose, for a period of 5 years. And let me just put this down in the form of an example to understand this in a better manner. Let's suppose acquirer is B and acquiree is D. So this is the acquirer. This is the acquirer. Okay. Now, acquirer prior to business combination transaction has given a right to acquiree. Yeah. And this right is given to acquiree for a period of 5 years. Okay. Now, let's suppose after 4 years, there's a business combination transaction because of which D gets acquired by B. Now, at that point of time, this right is reacquired. Excuse me. Now, after 4 years, this right is kind of reacquired by B from D. Yeah. Now, when this right is reacquired by B from D, this right, which happens to be in the nature of intangible asset, this will also be fair valued. Yes or no? When this is fair value, at that point of time, for the purposes of its fair valuation, its life is considered to be 1 year. Why? Because this life of acquired right by D from B is only 1 year. Correct? And which is getting reacquired in a way. So you may be thinking, but why is B fair valuing its own right? Because that contract exists with D for another 1 year. That's why it's getting fair valued. Now, even though we are fair valuing this reacquired right, using a life of 1 year, that means the residual life, you can say. It is not necessary that the right will only have 5 years as its life. It may be possible that after 5 years, this right may get renewed or may get renewed with another party. Yeah. Standard says that while doing the fair valuation of this reacquired right, we should only consider the balanced life as per the original contract. We should not consider the life which will come or which will add due to the renewal period. And if we add the life as per the renewal period, then the fair valuation of this reacquired right will change. Yes or no? So currently, we are doing fair valuation taking 1 year as the life. Let's suppose this right may get renewed for another 2 years. Then the life for reacquired right should become 3 years. Now the fair valuation which is getting considered is based on 1 year as the life. Let's suppose fair value based on 3 years as the balance life is considered, then definitely this will be different from this one. Yes or no? Yeah. But for the purposes of business combination accounting, which fair valuation do we use? This one and not this one. Understood? That's why this also happens to be an exception to the principles of fair valuation which are applied at the time of business combination accounting. Clear? All of you? Yeah? Any questions, any doubts in case you have, please let me know. Are you all clear on all of these exceptions? If you have any questions, any doubts, please let me know. Let me just pick up some examples now, which we can practice for all of these exceptions. Just 1 minute. In the meantime, you can let me know if you have any query around any of these points that we have discussed. Quickly, any doubts, any questions in case you have. So all of these exceptions are again very important because on the basis of these exceptions, the valuation criteria or the measurement criteria, the recognition criteria change. Okay, so let's move on to the questions then. So there was a few questions around contingent liabilities, which I think we can definitely have a discussion on. Okay, now very simple question once again for you. And it's all about the exceptions. Okay. Burger King sells burgers. Experience suggests that 1 in a million burger sold is contaminated. Burger King was acquired by Pizza King. So it's a case of business combination. Who is the acquirer? Pizza King. And who is the acquiree? Burger King. On the date of acquisition, Burger King, that means the acquiree, had sold 1 million burgers in the past week or so. Now in this case, you need to tell me, it's over to you now. Should Pizza King, that means the acquirer, provide for the liability in the acquisition accounting that may arise on the contaminated burgers? Yes or no? Quickly. You remember one of the exceptions we discussed? Yes, quickly. In the meantime, I received this query from Ambika. Ambika is asking, so normally, as per business combination, transactions are derecognized. Which transaction you are asking, Ambika, if you can clarify? When you say normally as per business combination, transactions are derecognized, are you talking about the transactions between the acquirer and the acquiree? Yeah, that is called as pre-existing relationships. So if there is any pre-existing relationship, that will come to an end. Okay. Yes, now I'm waiting for a response on this particular example. Yes, it's a simple one, small one. Quickly, yeah. I need your response quickly. Yes, quickly. What will be the answer in this case? Will the acquirer be required to record a liability or not? Yes. Okay, Ankit has answered this. Yes, the acquirer should provide for this liability. Okay, what about others? What about others? Quickly. Ankit has responded to this. What about others? Should this be recognized or not? Or what should be the accounting treatment over here? Pujita is also saying it should be recognized. So let's understand in this case. Pizza King should not provide for this liability. Why? Because if you understand this transaction, it's not a present obligation. You remember? Which contingent liability will get recognized? The one which is in the nature of present obligation, not the one which is possible. What is probable? Sorry, what is possible? For which likelihood is not more than 50%. And in this case, there is uncertainty. There is uncertainty in terms of whether it will happen or not. That's why, what do we call this obligation as? Possible obligation and not the present obligation. And considering that this is a possible obligation, that's why it will not be recognized. Therefore, the acquirer should account for this liability in the post-combination financial statements only if this case is reported. Why? Because when this case gets reported, then of course this will have to be recognized. Clear? All of you? Ambika has answered this saying that if Ind AS 37 provides, then it needs to be reported. Now, please understand that in the exam, whether Ind AS 37 provides or not, this is again something you'll have to assess. Okay. Anjali also answered this question saying it should be recognized. I think now you must be clear as to why it should not be recognized. In the question, you'll have to at times assess whether it will be a possible obligation or a present obligation. I'm not sure whether you have covered Ind AS 37 or not. If not, then when you will cover Ind AS 37, you will get more clarity around this principle. Okay, yeah. Have you covered Ind AS 37? For my understanding, you can just let me know. Ind AS 37 you have covered or not? Yes, quickly. Can you please tell me whether you have covered Ind AS 37 or not? Ind AS 37 you have covered? Tell me. Yeah. While you answer this, we can now move on to the next principle, and that is about NCI. NCI is another component which you will see will have an impact on the goodwill computation. We'll see as to how it will have an impact on goodwill computation. And we have also discussed about NCI. What do we mean by NCI? It's those shareholders who do not have controlling interest, who do not have control over the acquiring. Okay. And in various situations, we get to see NCIs there, because it's not always that the acquirer will have wholly owned acquiring. He will have, say, majority stake in case of acquiring, but it's not necessary that he will have wholly owned acquiring at all times. That's why it becomes another important area for us to understand and to know as to how do we record NCI. Now, standard gives us a couple of options, and these are options. Options means company will have a choice. NCI can either be measured at fair value. Fair value means simply compute the fair valuation of NCI for its measurement. It's the first option. Okay. First option is to compute fair value of NCI simply. Or the other option is option number 2. We will get fair value of net assets of the acquiry. We will have fair value of net assets of the acquiry. Let's suppose percentage share of NCI is 15. Now, 15% of the total fair value of net assets of acquiry will become fair valuation of NCI as per this second method. Means proportionate share of acquirees net and identifiable net assets. This is another option which is available. Standard further says that either of these methods may be used for measurement of NCI, and when we use either of these methods, it can be chosen on combination by combination basis. Means it is not necessary to have an accounting policy to say that NCI will always be measured at fair value. No. Let's understand this point. What do I mean by this? Let's understand this point. What do I mean by this? Let's suppose an entity had 3 business combination transactions. 1, 2, 3. Okay. Now it may happen that in case of business combination transactions, 1, NCI was measured at fair value. Another one also took place within the same financial year. Let's suppose this was 1 financial year. Okay. In respect of second business combination, NCI was measured at using proportionate share. Yeah. Then once again, in the next financial year, there was another business combination transaction wherein once again fair valuation of NCI was considered for its measurement. So what does it mean? That on the basis of business combination, entity can apply the method of valuation of NCI. It's not necessary to have its accounting policy as fixed for any entity. Okay, yeah, clear? And I've received many responses in the meantime. Pujita, Ankit, Anjali, Ambika, they are saying they've not covered Ind AS 37. Okay. So if you have not yet covered Ind AS 37, then one point which you can note along with your notes, wherever we have covered contingent liabilities and indemnification assets. Okay, please go back to your notes. If you have been making your notes, please go back to your notes, or maybe somewhere please note down. Yeah, wherever you have noted contingent liability and indemnification assets. In those 2 points, put an asterisk mark or put a note and say that this needs to be read along with Ind AS 37. Give an asterisk mark or a reference of Ind AS 37 over there. So that later on, when you cover Ind AS 37 and when you will have clarity around these principles in detail, then you should come back to these 2 points under Ind AS 103, and then you should reassess whether you are able to answer these questions at that point of time or not, because currently it may be difficult for you to answer. Okay, and that will be the best way to revise Ind AS 37 and also understand this particular part of Ind AS 103 in a better manner. And that will also be an interlinkage of 2 standards. Okay, clear? Yeah. Okay, so moving further. Now you get to see the complete picture. Huh? On the screen, if you'll see this complete picture, Ambika had this query around settlement of any transaction prior to the business combination. So that's true. If there's any prior transaction, okay, which will have any balance between the acquirer and the acquiree, those will get settled. Those will get settled at the time of business combination. Okay. Now what you will see is about the full picture of how goodwill is required to be computed. So when we talk about computation of goodwill, there are few elements that we have already covered. How do we compute goodwill? We pick up purchase consideration first of all. Where is that component? This one. This we have already discussed. From the purchase consideration, what do we reduce? Net assets. We reduce this. This part is also covered by us. Okay. And the net assets herein will also mean that will include intangible assets. Okay. There are 2 more components which are required to be considered when we compute goodwill. What are those 2 components? NCI and previously held equity interest. Now, NCI is again something that we have discussed, but we have only discussed NCI conceptually. We have not practiced any question using NCI, correct? We have not practiced any questions, so we'll have to practice questions also using NCI. That is one. Secondly, other than NCI, there are many other things which are required to be considered. And what are those many other things? Those basically arise from the requirements of step acquisition. Okay, so let's understand about those principles. So now I'm just digressing from this discussion once again, and I'll come back to this. Okay, I'll come back to this. So first of all, I'm taking you to step acquisition. We will discuss certain principles around step acquisition, and then we'll just mix up all of these things to come back to our discussion. So what is step acquisition? Just give me 1 minute. Now there's a transaction which is taking place between two parties, C and D. C is the acquirer, D is the acquiree. Okay. Now in relation to C and D, the acquisition of D is not really happening in one go. So far, all the examples that we have discussed, all the situations that we have considered, therein we used to talk about a situation when D used to get acquired by C, or acquiree used to get acquired by the acquirer in one go. In one go means in one go, acquirer used to obtain control of acquiree. For example, when we discuss 60% interest of acquirees obtained, 90% interest of acquirees obtained. That was all about getting the acquiree or getting the control over the acquiree in one go, which may or may not happen. Yes, so we are not saying that it will not happen. Yes, of course this happens, but not necessarily. So another way through which acquirer may get control over the acquiree or acquirer may acquire acquiree could be in steps. Let's see how. Let's suppose in the first instance, acquirer has obtained 10% shares of D. So C bought 10% shares of D. At that point of time, when only 10% shares are acquired, will C get any control over D? Not really. Okay, I'm assuming there is no control. Let's suppose after some time, say this is 29 May. Yeah, let's suppose after some time, say 28th of August. Now C acquires another 25%. So what is the total holding? 35%. Now once again, after acquiring 35%, do we say that C has acquired control over D? Not really. Even now, C doesn't have control over D. Okay. Let's suppose on 3rd March. So say this was 2020, this was 2020. Let's suppose, or I should change the data because this is not really there. Let's suppose on 18th of December 2020, 35% stake is obtained. Now, what is the total holding? It's 70%. Now the total holding becomes 70%. Now C gets control over D on this date. Now in this situation, if you'll see, C is not getting control over D in one go. It's happening in stages. When is the control actually acquired? Control is actually acquired on 18th of December 2020. Now I have few questions before I move further to test your knowledge. Okay. First of all, tell me what will be the date of acquisition? A. From which date? From which date D will become subsidiary of C? Subsidiary from which date? Quickly, if you can answer these two questions. Pujita is saying date of acquisition will be 18th. What about others? Let me just understand from all of you. Yes, quickly. What will be the date from which D will become subsidiary? Pujita is saying, sir, that is also same date, 18th. Chavi is also saying, sir, date of acquisition will be 18th of December. Very good. Now in this case, what do we know? We know that date of acquisition has to be the date when the control is obtained. When is the control obtained? 18th of December. Prior to 18th of December, even though C was holding shares of D, but can we say that was the date of acquisition? No, because there was no control. So even though C was holding 35% shares on these two dates, still business combination accounting will not be done on these two dates. When will the acquisition accounting be done? On 18th of December. But does it mean that C will have to ignore its acquisitions on these two dates while doing the business combination accounting? No, it can't be ignored. On 29th of May, for acquiring 10%, C must have paid something. Correct? So he paid some purchase consideration, number one. Then for acquiring another 25%, he must have paid another purchase consideration. Purchase consideration number two. Then for acquiring another 35%, he must have paid purchase consideration number three. Yes or no? He must have paid purchase consideration number three. Now, this purchase consideration is something which we have already discussed as a principle. Okay, we have already discussed as a principle. But what about these two purchase considerations? Can we ignore them? No. These two acquisitions will be called as previously held equity interest or interests. Why? Because these are previously held interests in equity. What is interest in equity? Stake in equity. So when we do business combination accounting, these two will also be required to be considered. And at what value? At fair value. Because what is the valuation that we consider for business combination? Fair value. So these two should also be fair valued. But another point which needs your consideration. When we compute the fair valuation of these two or any of this, the fair valuation of previously held equity interest should be as of the date of acquisition. So will not compute the fair value of previously held equity interest on 29th May. No. Will not compute the fair value on this date. No. We will have to consider the fair value as of 18th of December 2020. Okay. Clear? Clear about this? Yeah. I have received many responses in the meantime from Preeti, Nanda, Usha, Anjali, Ambika, Pujita about this consideration. Great. And all of them have been talking about the same answer, that is about date of acquisition. Very good. Anjali is saying that prior to this control, these two investments will be considered as normal investments. Okay. Now, before I move further, another very important question for all of you. Now, this is important from examination perspective also, and something we have already covered. These two, this one let's suppose is A, and this one let's suppose is B, and this one let's suppose is C. Okay. Now in this case, investment by C into D on this date and in this date. What do we call these investments as? Or can you tell me what will be the criteria for recognition and measurement for these two investments? Only A and B. For A and B. Yes. Once again, I am waiting for your answers. What will be the recognition and measurement criteria for A and B? Yes, quickly, over to you now. See, all of these things we have already covered. We have already discussed. So it's a good way to revise all these points. Yes. And I'm sure that you know the answer. Yes, I'm waiting for a response. Yes. What will be the recognition and measurement criteria for these two investments? Quickly, why you are taking so much time? Yes, tell me quickly. It's simple, easy, huh? Something that we have already covered. Tell me. See, about this investment we know. How do we recognize it? How do we measure it? This is something we have been discussing. But these two investments, A and B, how do we recognize them? How do we measure them? I'm saying prior to business combination. Prior to business combination. How do we measure them? Quickly, you can just tell me about that. How do we measure them? Yes, I'm waiting for a response. I think Anjali started speaking something about this. Tell me. No response so far. Quickly, I need your answers. Okay, great. Anjali has answered this. Anjali is saying these two will be measured at fair value through OCI, because these two may get covered into the exceptional category, and these two are financial assets. Excellent. Very good response. What are these two items? These two are financial assets. And can these two be measured at amortized cost? No. Can these two be measured at fair value through OCI? No. How can these two be measured? These two can be measured at fair value through P&L. But even though these are required to be measured at fair value through P&L, there is a designation option available. So, using that designation option, either these two can be measured at fair value through OCI, or if not chosen, then these two will be measured at fair value through P&L. Okay. So prior to business combination, these two will be measured at fair value. And when the business combination happens, then this will become a subsidiary, and then this will start getting consolidated under Ind AS 110. Clear? Prior to business combination, these are not subsidiaries. That's why we are considering these as normal investments. In fact, when this achieves 35%, this may be considered to be an associate. But I'm just ignoring that aspect for the time being. Okay, clear? Clear on this? Yeah? Let us now go back to our discussion. So we were discussing about computation of goodwill. Non-controlling interest we have discussed. Previously held equity interest we have now discussed. What do we mean by this? Now, whenever goodwill will be computed, what do we need to consider? These four items. We will take purchase consideration. What is purchase consideration? This one. And to this purchase consideration, can we ignore these two? No. So we need to consider these two also. Now, when these two will be considered, we'll call these two by a different name. What are the names attached to them? Previously held equity interest. So you can now assume that these two are no different from purchase consideration. So that means purchase consideration including previously held equity interests. Okay. Now the purchase consideration has actually expanded. Earlier, it only used to include purchase consideration which was paid upfront, which was deferred, or which was contingent. Now to this purchase consideration, we will also include something which is paid prior to getting control in the form of previously held equity interest. Okay. Number two. Now, when we are computing the goodwill, we also need to consider the amount of NCI. Because NCI is also attributed towards same net assets. Yes or no? Now the amount which has been paid to acquire net assets is something, let's suppose, is 80%. But the value of net assets that we have picked up is full. See, the value of net assets that we have picked up is 100%. But the purchase consideration is only towards 80%. So what is the idea? Idea is to compute the goodwill in the overall business. And how do we get to that computation? Pick up that 80% amount also, even though it's not paid, but it's only for computation of goodwill. So what do we do? Now, after purchase consideration, we will include NCI. And from these two, means purchase consideration including previously held equity interest and NCI, we reduce net assets. From this, we reduce net assets. The resultant amount will be goodwill. Goodwill is always a balancing figure, correct? The resultant amount will be goodwill. Okay, yeah, clear on this? Now we can move on to some questions. Yes. So now we can move on to some questions to practice this. Now with the help of this example, we will practice three things. One, that is about NCI. Second will be about previously held equity interest. And third, computation of goodwill. So I would say it's a very good example which will cover various ingredients. And this will also test your knowledge at multiple places in terms of what all things you remember and what all things you don't remember. So I would say it's a very good example for the purposes of your revision also. So maybe you can just mark it. This example, you will get the presentation. So don't worry, you may be thinking, but sir, we don't have the presentation. You'll get the presentation very soon. Maybe when you do your revision later on, you can mark this example. This will be a good way to revise various concepts. Okay. Investor acquires 20% ownership interest in investee. Who is an investee? A service company. On 1st of January 2000X for 3.5 million cash. So the purchase consideration paid to acquire 20% interest is 3.5 million. At that date, fair value of investee's net identifiable assets is 10 million and carrying amount of those assets is 8 million. So for my purposes, I'm just noting this acquisition on the board. If you want, you can also note this on your own. You can just continue with this example. You can just complete this example and start solving this example. Anjali, I'll come to your query. Huh? So on 1st of January, (2000X), 20% interest is acquired. On this date, purchase consideration paid is 3.5 million. And on this date, net identifiable assets of acquiree, in terms of their fair value was 10 million. And the carrying amount of those net assets carrying amount was 8 million. Okay. Investor does not have significant influence over investee. What does it mean? That on this date, investee is not considered to be an associate. It's normal investment. Investor treated these investments, means 20% investments, as fair value through OCI. These were measured at fair value through OCI. Why? Because if you remember, I told you in the last session also that whenever any stake is acquired and that investment is in a subsidiary, JV or associate, then the standard gives us an option to measure them at cost instead of fair value. Yeah. Now, because these are available to be measured at cost, that's why these are the generally chosen options. But in this case, it's not possible. Fair value of investment as at 31st December 2000X was 6 million. Now at year end, 31st December 2000X, this fair value was 6 million. Fair value of what? Of this 6 million. Okay. Accordingly, investor recognized unrealized gain of 2.5 million in equity. Now, this is a very interesting point. Let's understand. See, what was the cost of investment? Cost of investment means amount which is paid by the investor to get the acquiry. Cost of investment was 3.5 million. Correct? This was the cost. And we understand that going forward, this investment will be measured at fair value. So this is measured at fair value. Now at year end, against 3.5 million, what do we see? Its fair valuation becomes 6 million. So what is the difference? 2.5 million. Where do we take it? We take it to OCI, and from OCI it goes to equity. From OCI it goes to equity. And why are we doing that? Because it's a normal investment which is dealt as per the principles of Ind AS 109. And once again you will be thinking, sir, every time we are discussing any example, any situation, what is happening? Are we covering financial instruments or business combinations? See, this is what I told you earlier also, and that is something you'll have to remember for your examination also, that various concepts are interlinked, and that's why it's very, very important for you to just link those concepts whenever you practice any question of any accounting standard. Okay, clear? So we once again apply the principles of financial instruments, and we see that 2.5 million goes to equity, routed through OCI. Okay, yeah. Now let's move further. Let's understand the remaining facts. On 1st of January 2000 X1, that means on this date, 1st of January 2000 X1, investor acquires another 60% in the same investee by paying 19 million in cash. So earlier it was 20%, now 60% another thing has been acquired, and the purchase consideration paid is 19 million. Okay. Thereby obtaining control. Now he has got control. So what does that mean? It means now we'll have to start doing business combination accounting. Very good. This amount includes control premium of 1 billion. At that date, means on this date, fair value of investees' net identifiable assets is 12 billion. So fair value of net assets is 12 million. Fair value of net assets. It's not the fair value of previous investment. No. Fair value of net assets of the acquired. And the carrying amount of those assets is 10 million. Okay. Investees' profit for the year 2000X is 2 million. During this year, profit of investee was 2 million. Fair value of NCI. Now, what is NCI? On this date, what will be the percentage of NCI? 20%. Why? Because 20 plus 60 goes to the investor. 80% goes to the investor. So, what will be the percentage of NCI on this date? NCI will be 20% on 31st of December, or you can say on 1st of January 2000 X1. Yeah. And the fair value of original investment. What was original investment? This one, 20%. So fair value of NCI and fair value of previously held equity interest on 1st of January 2000 X1 is also given to you in the question. What is that? 6 million. 6 million is the fair value. Previously held equity interest, which was 20%, that is also 6 million in terms of fair value. And all of these numbers are on which date? 1st of January 2000 X1. Okay, clear? Yeah. Now we need to solve this. And what do we mean by solving this? We need to compute the amount of goodwill or capital reserve in this example. Can you start solving this on your own? All of you, can you start solving this on your own? I have put down all the facts on the board, and all the facts are also available on the example. Can you quickly compute the amount of goodwill and let me know the answer? I am waiting for a response. Yes, all of you, can you quickly compute the answer and let me know the amount of goodwill? See, all the things we have discussed. Anjali, I'll discuss this query also which you have raised. Yes, 2-3 minutes is what you'll get, and then you need to answer this, please. Yes, you can start sharing your responses if you are done. You can start sharing your responses if you are done. I'm waiting for your responses now. Yes, quickly. You can start sharing your responses. Very good. Anjali has shared the response. Anjali has computed the goodwill and it comes out to 15 million. Great. Anjali, do you have any other answer? Please remember that you may have two different answers if you follow two different methods for measurement of NCI. Remember, NCI can be measured using two methods. And please remember that using two different methods, amount of goodwill may change, and that is permissible. So don't think that by using both the methods, answer of goodwill should remain always same. No, it may change. All other students, I'm waiting for a response. Anjali has solved this. Can you start sharing your responses quickly? Yes, quickly. Huh? Okay, so let's go to the solution then. See, in this case, there are few things that we have already covered. That is about the first year when the control was not acquired. 20% investment. 20% investment, this one, which is previously held equity interest. This will be measured at fair value through OCI. This will be measured at fair value through OCI. This will be fair value, and the difference between fair valuation and the cost of previously held equity interest. That means a gain of 2.5 million will go to equity. This will go to equity, correct? Now, let's move further. Now we will start computing goodwill. And when we compute goodwill, we have two options available. Either to measure NCI at fair value or to measure NCI at proportionate share of fair value of net assets. Depending on the option chosen, amount of goodwill may change and capital reserve may be there. Yeah. So what do we start with? We will start with the cost of acquisition. What does it mean? Purchase consideration plus fair value of previously held equity interest. So what is the purchase consideration? Paid 19 million. And what is the fair value of previously held equity interest on the date of acquisition? 6 million. So 19 million plus 6 million. What do we get? 25 million. Ambika has also solved this, and Ambika is getting 13 million as the amount of goodwill. Great. Let's see why your numbers may or may not be matching. Excuse me. Now, what's the next step? We have considered two elements: purchase consideration and fair value of previously held equity interest. In both the methods, these two amounts will remain same. Yeah. Okay. Next is to consider the amount of NCI at fair value. Is that available to us in the question? Yes. That is 6 million. 6 million. So what is the total of these two? 25 plus 6, 31 million. From this, what do we need to reduce? Fair value of net assets of acquiree on the date of acquisition. Is that available to us in the question? Yes, that is also available to us in the question. If you go back in the question, it says fair value of net identifiable assets is 12 million. 5 million. So 31 minus 12, what do we get? 19 million. 19 million is the value of goodwill using option where NCI is measured at fair value. Okay. Let's suppose if we go to option number 2. In case of option number 2, do we have fair value of NCI? No, because that is not the option we have chosen. What do we do there? We will compute proportionate share of NCI. So what's the share of NCI? 20%. 20% of fair value of net assets of query. So what's the fair value of net assets of the query? 12 million. Into 20%. What do we get? 2.4 million. Yeah. Pujita also solved this, and Pujita is getting 15.4 million as the goodwill in option number 2. Very good. Now with this, what do we get? Total of purchase consideration plus fair value of previously held equity interest plus NCI 27.4 million. From this, the component of fair value of net assets will remain same, 12 million. So what do we get? 15.4 million as the amount of goodwill. Correct? We get 15.4 million as the amount of goodwill. Yeah? So we can see how simple it is. You may be thinking, sir, this is so simple, and we were wondering so many computations will have to be done. So much complexity will arise. Do you find this complex at all? No. Isn't it? Tell me, do you find this complex? Yes or no? One thing is for sure, and which may be a big point of your confusion at the time of exam, that sir, even if we use two different methods, should the amount of goodwill not remain same? Will it be logical? Yes, absolutely fine. Standard permits this because it's mathematical. Goodwill cannot be same using two different methods. It has to be different, and this is permissible. And it doesn't mean that the entity will compute both the amounts of goodwill. Entity will choose only one method, whichever it likes. That's an option available to the entity. Now, in the exam, next question, in the exam, you may be thinking, but sir, how do we know which method is required to be applied in the exam? See, that will depend on a couple of things. One, either the question will specify how do you need to compute goodwill, means using which method. If the question is silent, then the information should be available for computation of goodwill using two methods. And in such a case, you should use both the methods. In case the information is not available for one of the methods, you should use the computation, you should use the method for which computation can be done. And you should also give a note in the question that this is the method you have chosen because the information around the other option is not available. Okay? Clear on this? Clear on this point? Ambika is saying, no, sir, it's not complex at all, easy. Pujita is also finding this to be very easy. Okay, let me just go back to the query of Anjali now. Anjali is asking, sir, why are we adding NCI while calculating goodwill? Now I am hoping that you must have either got the clarity, but still, let's understand this. See, when we have picked up fair value of net assets, we did not limit ourselves to 80%. Did we get, sorry, where was this amount? Fair value of net assets of the acquiree, 12 million. Did we say that this fair value of net assets of acquiree is only for 80% share? No. We have picked up total amount of fair value of net assets. So when you pick up a base of total amount of fair value of net assets of the acquiree, your other component from which it will be reduced, can it really be 80%? No. This should also be 100%. Only then you will get the correct amount of goodwill. So if you reduce NCI from this, the goodwill will get impacted. And why we are considering it? Because we are considering all the stakeholders and all the amount, or you can say the entire amount, which has been acquired by all the stakeholders. Only then you get the correct amount of goodwill. Clear? Clear on this? And with this, you must have understood that so many concepts were involved and which were interlinked and which were sort of mixed up. So in this example, we have discussed the application of Ind AS 109. Yes or no? In this example, we have discussed about computation of goodwill in totality. Purchase consideration we could discuss. Previously held equity interest we could discuss. NCI we could discuss. Fair value of net assets we could discuss. Computation of goodwill is of course the requirement of this question. Yeah. So many principles were involved here. That's why I said it's a very good example to revise many points related to goodwill computation. Okay. Yeah. Okay, let's move on to this example now, a small one. Yes, all of you, can you go to this example now? ABC Limited acquires PQR on 30th June 2017. Assets acquired from PQR Limited include an intangible asset that comprises wireless spectrum license. For this intangible asset, ABC is required to make an additional one-time payment to the regulator in the jurisdiction of PQR in order for the rights to be transferred for its use. Whether such additional payment to the regulator is an acquisition-related cost. Let me just tell you, if there are any costs of acquisition or if there are any costs related to acquisition, those are required to be expensed off. Acquisition-related costs are charged to P&L under Ind AS 103. Except debt security issue costs. What are debt security issue costs? Costs incurred to issue debt. What do we do with that? Remember Ind AS 109? We compute effective interest rate. Similarly, if there are any costs incurred to issue equity, what do? We adjust that with equity. Again, go back to the principles of Ind AS 32. So if there are any acquisition related costs, all of them will be charged off. Now in this question, we are just trying to understand first of all. So let's understand this requirement. As per Ind AS 103, acquisition related costs incurred by an acquirer to affect a business combination are not part of consideration transfer. Okay, those are not considered to be part of purchase consideration. I'm talking about acquisition related costs. Ind AS 103 further states that acquisition related costs are the costs that the acquirer incurs to affect a business combination. Those costs include, what are those costs? Now it is okay. All of you, can you please confirm, is it okay now? Jay, please let us know whenever there is any problem. Anjali, is it all okay? I can see this query from Anjali that the video has stopped. All of you, please confirm, is it all okay? Quickly, I'm waiting for a response. Okay, Anjali is fine with this, and I'm hoping that all of you are able to understand. So I'm not really sure as to where did I lose. So I'll just quickly repeat this point. Yeah, around this acquisition of right. Now, in this case, the payment to the regulator was in the nature of a transaction cost. And if that will be a transaction cost incurred during the business combination, that should be expensed off. Now, we need to understand whether it should be considered to be a part of business combination or it should be considered to be a separate transaction. Because if this will be considered to be a separate transaction, means other than business combination, then we'll say the right has been acquired on which Ind AS 38 will apply, and wherein any cost incurred to acquire the right, acquire the asset, will be capitalized along with the cost of the asset. But in this case, what did we understand? Transfer of rights cannot be construed to be separate, because transfer of rights is an integral part of business combination itself in the given case, on the basis of our understanding of this example. That's why, what do we do with those costs? Charge off. Take it to P&L straight. Clear? All of you? Yeah? All of you clear on this? Any questions, any doubts in case you have on this, please let me know. Yes, quickly. If you have any questions, any doubts, please let me know. Yes, any questions, any doubts? Then we can move on to the next part, please. If you don't have any questions, we can move on to the next part. No questions? Anjali is saying, sir, I did not understand this. Yes, okay. See, what is the principle? Principle that we have tried to understand in this situation is that whenever we do any business combination, there could be certain transaction costs. Transaction costs, you remember? For example, when we issue any debt, some legal fees may have to be paid. Some valuation may be required to be done. Some administrative costs may be incurred. All of these costs are what? Transaction costs. You remember transaction costs at the time of financial instruments we discussed? What do we do with those transaction costs? So when we obtain any loan, when we take any loan, any upfront fees, any borrowing fees, any legal fees, any consultant fees, which is incurred specifically for obtaining a loan, what did we do with that? That was adjusted with the amount of loan. and effective interest rate was computed. Remember? So what does it mean? It's not charged off to P&L straight away. Yes. Similarly, if we issue any equity instruments, and if any transaction cost is incurred for issuing the equity instruments, there again, under finance instruments, we discussed that any cost incurred for issuance of equity instruments will not be charged off, that will be adjusted with equity. We discussed a couple of examples for both these points. Yeah, clear? Okay. Now, with this understanding, few situations may arise. And I'll just put down all those situations in the form of a chart for your reference. So we are talking about transaction costs. Let's suppose it is related to debts issuance. So what do we do in this case? Adjusted with debt. And we compute EIR over here. Which standard do we apply? 109. Remember? Yeah, Anjali is saying now understood. Very good. Now the other point was around equity. Let's suppose if we issue equity, then what do? This is also adjusted with equity. Though you are clear, but still, I'll just note this one for your reference. This is adjusted with equity. Correct? Let's suppose if we incur any transaction cost for purchasing any PP. Let's suppose you are purchasing furniture. For purchasing furniture, you incur some transaction cost. What do? Any cost paid for bringing the asset to its present location is capitalized with the cost of the asset. Something you would have covered under Ind AS 16. So what do? Capitalize with PP. Which standard you will apply? 16. Similarly, if there is any intangible asset, you will acquire. If there is an intangible asset, you will acquire. You will capitalize that with the intangible asset. Which standard you will apply? 38. 16 or 38, depending on the item you purchase. Similarly, during business combination also, you may be required to pay costs for legal expenses. Legal fees may have to be paid. Consultant fees may have to be paid. Valuation fees, etc. may have to be paid in the nature of transaction costs. In that case, standard says you will not capitalize them. You will not adjust them. These are the exceptions. But any other item which is a part of business combination should go to P&L straight away. And which standard we are considering here? We are considering 103. Okay. Maybe you can just note down this chart. This should be helpful for your understanding around the treatment of transaction costs under various standards. Okay. So this chart should really be helpful to you. You can note down for the purposes of your notes. This will be helpful to all of you. Now clear? Clear on this? Anjali, I'm hoping you are clear on this. All of you, you are clear on this now? Tell me. Yes or no? Anjali is here. You can note down all of these points which are there on the board. And if you have any questions, any doubts, please let me know. No questions, no doubts. So now what we can do is we can take a break. After the break, we will continue with our discussion on business combinations and we'll move on to the next topic. Okay. Yeah. Perfect. So let's go for the break now. Hi, welcome back. So we'll now continue with our discussion. So we'll move on to next topic, that is bargain purchase. If you remember, when we started computing goodwill, we discussed a situation wherein goodwill amount may become negative. You remember? And when it becomes negative, we also discussed that the moment goodwill becomes negative, it will be called as bargain purchase, or it will be presented in the form of capital reserve instead of calling it as negative goodwill. Now, on this aspect, there's also a difference between goodwill in terms of its presentation under IFRS as well as Ind AS. Under IFRS, we continue to call this negative goodwill as negative goodwill. Okay, so we don't change it to capital reserve. So this terminology of capital reserve has been given only under Ind AS. Secondly, whenever there is a good situation of negative goodwill, it goes to P&L under IFRS as compared to Ind AS, wherein we take it to capital reserve. Now let's get back to our discussion of negative goodwill. So what do we mean by negative goodwill first of all, or this bargain purchase? Bargain purchase indicates a situation something like this. Let's take one small example, something like this. So the purchase consideration paid is 1,500. Fair value of net assets acquired, let's suppose, is 2,500. So what do we get? Negative goodwill. And instead of goodwill, we call it as capital reserve. This situation has been considered by the standard as bargain purchase. This indicates a situation wherein purchase consideration is lower than value of assets acquired. Means buyer was in a dictating position, or you can say seller was in a situation of acceptance. This generally arises in case of a distress situation, wherein seller is under some sort of stress. Otherwise, this will not be possible. Only when the seller will be under some sort of stress, he will enter into such deal, when he will be giving assets having fair valuation more than what he is receiving. Yes or no? Yeah. This type of situation is therefore called as bargain purchase. These type of situations are rare. You will not find these type of deals very commonly. These are rare. Commonly, you will find situations wherein the amount of goodwill will be positive, not negative. Standard also recognizes this fact, that such type of situations will be rare. These will not be very commonly seen. We can just relate this to the current situation. So the current situation of Corona, which is going on, there are a lot of businesses which have got impacted, which have not been able to survive because of the liquidity problem, because of the cash flow problem, and because of which they have been selling their stakes. Entire businesses are at times getting sold. And why is that happening? Because of stress. In those type of situations, we may see a bargain purchase. Now, considering that this bargain purchase situation has to be rare. Standard says that because we know that this is something which will happen when the seller will be under stress, when the seller will be under some sort of compulsion to enter into this transaction. Therefore, whenever we get negative goodwill, whenever we get this situation, we should reassess. We should reassess means we should reassess this PP exercise to check, are we really getting a bargain purchase or not? If the reassessment confirms that yes, it's a bargain purchase, if the reassessment confirms that it's a bargain purchase, then any gain is recognized in equity as capital reserve. What does it mean? That if it confirms bargain purchase, then we will take it to OCI. And from OCI, it will go to equity. Means it will get collected in OCI and OCI will sit in the form of a reserve, which is capital reserve. However, if there is no clear evidence, of this bargain purchase, means bargain purchase has been obtained, but there's no clear evidence because of which we can substantiate, yes, it's a bargain purchase. Then the standard says that such a gain, what is this gain or this negative goodwill, should not go to OCI. This should go to equity directly. Equity means in the form of capital reserve directly. I'll repeat my point. Standard says that if we are getting bargain purchase, we should reconfirm, we should reassess. If the reassessment confirms it's a bargain purchase, then the impact will go to OCI, or this difference will go to OCI, and from OCI it will go to capital reserve. If we do not get clarity around this difference, then this will not go to OCI. Instead, it will go to capital reserve directly. Clear? Clear about this? Clear on this? Yeah? Now, to understand this in a better manner and to get further clarity on this, we can discuss a couple of examples, illustrations here. So you can move on to page number 13.54. Example 18. Entity X is one of the largest liquor manufacturing company in the world, and it acquires another entity Y, which has significant presence in India and UK. However, the Competition Commission in UK has issued orders to sell one division of the UK assets of entity Y in order to comply with local competition regulation in UK within a specified timeline. Okay, so entity X acquires entity Y, and the regulatory requirements or the regulation over there requires one division of this Y or this acquiree to be sold somewhere else. Entity Z, another boutique liquor manufacturer, realizes the opportunity and purchases that division of entity Y from entity X. Why? Because now entity X is the owner of entity Y. In the given case, it is more likely than not that there could be an element of bargain purchase, as the entity X was under compulsion to sell the assets within a specified timeline. So whenever there will be a compulsion, there will be a stress, because they are bound within a particular timeline, they will have to sell it, and they may or may not get the right buyer, or the buyer who is ready to pay the right fair valuation. So it's a kind of stress, and whenever there's a stress, bargain purchase is possible. And another example for this we have discussed is about Corona. Yeah, when a lot of businesses are getting sold. We can now move on to one illustration which you need to answer. Okay, it's over to you now. You need to answer this. And sorry, this page reference was wrong. This was 5.2, and now we are going to 5.3. Illustration 21. Illustration 21. All of you need to answer this. Start reading this, please. On 1st of January 2000 X1, A Limited acquires 80% of equity interest of B Limited in exchange for cash of rupees 15 crore. A Limited acquires B on 1st of January 2000 and it pays 15 crore as cash. The former owners of B were required to dispose of their investments in B Limited by a specified date. So there was pressure to sell the interest in B on the former owner, and accordingly they did not have sufficient time to find potential buyers. A qualified valuation professional hired by the management of A measures the identifiable net assets acquired in accordance with the requirements of Ind AS 103 at 20 crore and the fair value of 20% NCI in B at 4.2 crore. Okay, so what he finds is that this should have been 20 crore and the NCI fair value should be 4.2 crore for 20%. How should A Limited recognize the above transaction? All of you, quickly, if you can answer this question. How should A Limited recognize the above transaction? Over to you. I'm waiting for the response. Yes, quickly, huh? You need to answer this. Yes, I'm waiting for a response. Yes, quickly tell me. Okay, Ambika is saying, sir, bargain purchase gain is 9.2 crore. Should be recognized through OCI. So how did you get 9.2 crore? Tell me. And I'm looking, okay, Preeti is saying, sir, 80 lakh should be the bargain purchase amount. Yes. What about others? Okay, I think Pujita is also getting the same answer. 0.8 crore, 80 lakhs capital reserve if NCI is valued at fair valuation. Okay, great. So let's go to the solution. In this situation, identifiable fair value of net assets of B is what? 20 crore. And that exceeds the fair value of consideration paid plus the fair value of NCI. Yeah. So fair value paid is what? 15 crore. And the fair value of NCI is what? 19.2. Ideally, if you look at the total fair valuation, 80% value is this, 20% value is this. So what's the total value? If we go by this transaction amount, 19.2 crore. But other than these transaction amounts, if we compute the fair value of B Limited, it comes out to 20 crores. That means clearly this transaction has been done at an amount below fair valuation. Yeah, clearly it's visible. Okay. Therefore, A Limited should review the procedures it used to identify and measure the net assets acquired and the fair value of NCI in B Limited and the consideration transferred. After the review, A Limited decides that the procedures and resulting measures were appropriate. So now it appears to be a case of bargain purchase. Correct? If this appears to be a case of bargain purchase, standard says A Limited should reassess. It's done and it's found to be appropriate. A Limited will therefore measure the gain on its bargain purchase. Yeah? And what is that gain? What is that gain? That is the difference between net assets, 20 crore, and the sum of purchase consideration and NCI. Okay. So what's that difference? That difference comes out to 19.2 minus 20 crore, 0.8 crore. Okay. Assuming there exists clear evidence of underlying reasons for classifying the business combination as bargain purchase, gain on bargain purchase of 80% calculated at rupees 80 lakhs will be recognized in OCI and accumulated in equity as capital reserve. So now in this situation, if you'll see, we have purchase consideration equivalent to 15 crore. NCI is 4.2 crore. So this becomes 19.2 crore. From this we reduce fair value of net assets 20 crore. So what do we get? 0.8 crore as bargain purchase gain. Now the question arises, where do we take it? If this reassessment is done, then we will take it to OCI, and from OCI it will go to capital reserve. Okay. if the acquirer chose to measure NCI in B Limited on the basis of proportionate share of identifiable net assets. Now, once again, we need to go back to our discussion on computation of goodwill, which was possible through two methods of valuation of NCI. In this case, we have considered option number one, or you can say first option, or option where the NCI was measured at fair value. Another option is possible, wherein the NCI may be measured at proportionate share of fair value of net assets. Let's suppose if that is done, how will the number change? In this case, NCI is measured at fair value. Let's suppose NCI at proportionate share is computed. Then what will happen? This will continue to remain 15 crores. But what will be the value of NCI? NCI will be 20% of 20 crore. 4 crore. So this becomes 4 crore. So this comes out to 19 crore. This remains at 20 crore. This becomes 1 crore. So the amount of bargain purchase will also change. Okay. So I'm reading the last para of the solution. If the acquirer chose to measure the NCI on the basis of proportionate share instead of fair valuation, recognized amount of NCI would be 4 crore and the gain on bargain purchase would be 1 crore, and its treatment will remain same. Its treatment will remain same. What will be the treatment? To check whether this bargain purchase is fine. If it is confirmed, then we go to OCI, and from OCI go to capital reserve. If not, if this is not confirmed that yes, it's a bargain purchase situation, then instead of OCI, this will straight away go to capital reserve. Clear? All of you? Clear on this? Yes, clear on this? Any questions, any doubts in case you have on this? I think Pujita also solved the same thing. Very good. Okay, I can see one query from Chella just now. Chella is saying, sir, I missed your class on Saturday, but covered that class on Sunday. I have a doubt in that while recognizing the portion of purchased goodwill, we consider the factors like brand name of the selling company, long-term contracts. My question is, why should we not take the brand name of the acquirer if the net asset is higher than the purchase consideration, that is, while computing the capital reserve? So I think the point which you are just trying to convey over here is that acquirer will also have some intangible asset. Why are those not considered? Why are we limited only to acquirees' intangible assets? Is that the question? Yeah. So if that is the question, you need to just please understand that whenever we are doing business combination accounting, we are picking up only the assets and liabilities of acquiring. Acquirer will not only have brand names or intangible assets. Acquirer will have a lot of tangible assets, a lot of other assets and liabilities, but those are not mixed up. It's the acquiring which is getting acquired. So we compare the assets and liabilities of acquiring with the purchase consideration paid. Okay, it seems that you have mixed up 2 points. So nothing related to acquirer should come over here except the purchase consideration paid by him. Okay, now clear on this? Any more questions, any more doubts in case you have on this? Yes, quickly. Any more questions, any more doubts? Tell me, then we'll move on to the next topic. No questions? All right, then we'll move on to the next principle, and that is about provisional accounting. You can also say measurement period. Now, what does it mean? So let's suppose we are into financial year ended 31st March 2020. And then we have another financial year ending 31st March 2021. Yeah. So let's suppose we are talking about 2 years. And somewhere over here, business combination took place. You can say somewhere around 1st or say 11th of May 2019. There was a business combination transaction. Yeah. Okay. Now let's try to understand about this business combination. We all know what is business combination, but let's try to get deep dive into this business combination. Business combination means business of another entity is getting acquired. If that another entity's business was very small, then it may not be very difficult to complete this acquisition exercise. Or you can say, instead of difficulty, completion of this acquisition exercise may be done over a very small period. Because if you look at acquisition of a business, it's not only about doing the accounting on a particular date. So far, we have been thinking that we will have to just pass an accounting entry on this date and it's done. It's not so easy. Let's try to understand this. When you have to do this accounting on a particular day, the acquirer will need records, information, documents of the acquiry. Yes or no? He will need all the financial information of the acquiry. He may get into a lot of details, or he may be required to get into a lot of details related to acquiry to complete this PPA exercise. And this PPA exercise is not so simple. This involves identification of intangible assets at times, which is not easy, which is time consuming, and then do the fair valuation of those. This also involves fair valuation of all the assets and liabilities of the acquiry, which is again not so easy. It takes time to complete that exercise. It involves a lot of other factors which are not really financial in nature, which are non-financial, which is about movement of data. So it's a transition exercise wherein the old shareholders will transfer their information, will transfer their records, will transfer entire business, will transfer all the documents to the new shareholders. And this at times takes months to be completed. If you look at large deals, large transactions which take place, this entire transition period is not something which will be done in a day or in a few days. This may run into number of months. And that's why at times it may happen that even though a transaction is completed, still its accounting may not get completed by the time financial statements of acquirer are required to be closed. Let's suppose another business combination took place on 15th of February 2020. And let's suppose acquirer requires to close its financial statements for the year ended 31st March 20 by, say, 15th of May 2020. Now, in this situation, it may be possible that the acquirer is not able to close its financial statements on this date, including the accounting of business combination. So does it mean that we can ignore this accounting? We can just live with not doing the accounting as per Ind AS 103? No, that's not possible. Accounting has to be done as per Ind AS 103. But in this case, standard gives us a leeway. Standard gives us some relief. What's that relief? Standard says that if for the genuine reasons for doing the accounting as per Ind AS 103, some information, some record, some data is not available, because of which accounting as per Ind AS 103 cannot be completed by the time acquirer is required to finalize its financial statements, then such accounting can be completed in the next financial year. Such accounting can be completed in the next financial year. And the accounting which will be completed, so you can say the partial accounting which will be completed up to this date, means in this financial year, this will be called as provisional accounting. This will be called as provisional accounting. This provisional accounting can then be finalized later on. Later on means in the next financial. In this year, this will be finalized. When the complete information, records, data, etc., which were not practically possible to be obtained or which were not available for general reasons, again, this has to be a general reason, then this is permissible to be pushed to next financial year. And if we push that to next financial year, it will not be considered to be an error. Standard says it will not be considered to be an error. So the acquirer will do provisional accounting as at 31st March 20 and will give appropriate disclosures for doing provisional accounting. Okay, he will specify that he has done provisional accounting and this will be completed in the next financial year. And in that case, it will not be considered to be an error. But next financial year doesn't mean full next financial year. Next financial year means this accounting should be completed within 1 year from the end of the date of business combination. Means standard gives us time of 1 year to complete the accounting as per Ind AS 103. Means if the business combination took place on 15th of Feb 2020, then the standard allows up to 15th Feb 2021 to complete its accounting without calling that to be an error. Okay. This will be done in the next financial year, but it should be done up to the date when 1 year ends from the date of acquisition. If this will be done after 15th Feb 2021, then this will not be permitted by the standard. Then it will be considered to be an error. Okay. Then this will be considered to be an error. Yeah. Now, various questions will come to your mind. You will say that, sir, what do we do in the next financial year? Let's suppose there are two situations. First situation is we complete our accounting up to 15th Feb 2021. But even if we complete it in the next financial year, the numbers which were recorded on this date, will they not change? Yes, they will change. So in that case, comparative numbers may also change. Is that allowed? Yes. Comparatives may also change and that is allowed. There's absolutely no problem around it. But sir, what if these are changed after 15 Feb 21? If those change after 15 Feb 21, even then the accounting will have to be done. But such accounting will be considered to be an error and not the accounting as per Ind AS 103. So there's a difference between these two. One which is permitted by the standard, and second which is not permitted, and hence that is considered to be an error in the accounting. Clear? Clear on this point? Clear on this principle? We will get more clarity on this principle when we pick up some examples. Yeah? So let's pick up one example to understand this in more detail. So let's pick up this example. Just give me 1 minute. Let me just. Yes, so we can move on to this example now. ABC Limited acquired XYZ on 28th Feb 2017. As part of the acquisition accounting, ABC recognized provisional amount of 1 crore in respect of patent developed by XYZ. However, the technology covered by patent was new, and ABC expected the cash flows to be generated by the patent to increase beyond those being generated at the time. Accordingly, ABC sought an independent valuation report from third-party consultant, which was not expected to be finalized for several months. ABC assessed the useful life of patent of XYZ at to be 10 years. On the basis of the valuation of patent of this 1 crore, goodwill worked out to 1.2 crore. And the same thing was considered in the provisional accounting. Now ABC has some patent which is required to be fair valued and which will take several months. Time is limited, so that's why what ABC has done is ABC has done provisional accounting. Consolidated financial statements. Why we are saying consolidated financial statements? Because when ABC will do the accounting, considering the financial statements or including the financial statements of XYZ, it will be consolidated only. The consolidated financial statements of ABC as at 31st March 17, that means year end, included appropriate disclosures about the provisional accounting. Now that is very, very important. Yeah. Subsequently, the valuation report got finalized. Means after the closure of financial statements, valuation report got finalized. And this valuation report got finalized before the measurement period. Before the end of the measurement period. What is the measurement period? 1 year from the date of acquisition is called as measurement period, technically. Okay. This period of 1 year is called as measurement period. Based on the valuation, ABC concludes that the fair value of patent changed to 1.5 crores. Earlier, when they did provisional accounting, they considered this to be 1 crore. Oh, so now if the value of patent will change, what will happen? Value of goodwill will go down. Because if the value of asset will increase, the resultant impact will go to goodwill. So earlier goodwill was 1.2 crore. Now the value of goodwill will go down. Yes or no? Management does not revise estimated life of the patent. So even though value has changed, they are saying life of patent, which was initially considered as 10 years, that will continue to be 10 years. It will not change. Now, in this case, you need to tell how should this accounting of ABC Limited be done in the year subsequent to the year when provisional accounting is done. So that means in 1718, how should the accounting be done by ABC Limited? Yeah, clear? Let's understand this. Okay, so let's move on to the solution. So we can just read the requirements of the standard first of all, and then we'll go to the computation. Ind AS 103 provides that if initial accounting for business combination is incomplete, mind you, incomplete, by the end of the reporting period in which the business combination occurs, acquirer should report in its financial statements provisional amounts for the items for which accounting is incomplete. It's permissible. During the measurement period means during the period of 1 year from date of acquisition till the date it ends. Yeah, till the date 1 year ends, acquirer should retrospectively adjust the provisional amount. So the earlier amounts which the acquirer recorded were provisional. They were like temporary. For the time being, those were recognized and measured. Now those should be adjusted from the retrospective date. Okay. To reflect new information obtained about the facts and circumstances that existed as of the acquisition date, and if known, would have affected the measurement of amounts recognized as at the date of acquisition. Now, considering the above requirements, what will the acquirer do? Acquirer should revise comparative information. Obviously, now in this case, acquirer would have recorded patents. Acquirer would have recorded goodwill. And the patents would also have been amortized over 10 years in 1617. Now the accounting will not be done in 1617. Accounting will be done in 1718. But even if accounting will be done, even if financial statements will be prepared for 1718, comparatives will be required to be shown. So let's understand this. Now in this case, what has happened? 1617 was closed. Acquirer would have closed 1617, calling this to be provisional. Correct? Wherein he would have recorded patents, he would have recorded goodwill, and he would have shown amortization of patent. So these two would have gone to balance sheet. This would have gone to P&L. Correct? Yeah. Patent was 1 crore, goodwill was 1.2 crore, and amortization amount I am not computing. Let's suppose this was some X amount. So this will be computed for proportionate period. Yeah. Now we will move on to 1718 because 1617 is closed. Now the question which arises is that even though for 1718 all these amounts will be rectified, yeah, but what do we do with these amounts? Do we need to change them? The answer is yes. when we will prepare the financial statements of 17-18, in those financial statements, the comparative amounts will also be changed. Okay. And why do we change that? Because we are doing retrospective accounting in this case. And you will be thinking, but sir, just now you mentioned we are doing accounting as per the requirements of the standard and it is permissible to do this later on. Then why we are going back to the financial year 16-17? And if we are not calling this to be an error, why we are changing these numbers? Now let's understand this point. See, doing retrospective accounting doesn't mean that it's an error always. Doing retrospective accounting in this case is doing the right accounting as per Ind AS 103, which could not be completed. So even though we'll be doing retrospective accounting in this case, we'll not say it was an error. We'll not say these are restated numbers. No. Okay, clear on this? Now let's see how will the numbers change. So I'm just taking you to the presentation once again and we'll compute the numbers over there. In accordance with above, acquirer should revise comparative information for prior periods presented in the financial statements, including making any change in depreciation, amortization, or any item of the P&L. Means will not be limited to balance sheet, will be covering entire set of financial statements. So based on above, comparative information presented in the financial statements for the year ended 31st March 18 need to be restated for the measurement period. Adjustment as follows. Let's see what is going to be the adjustment. Goodwill. Originally, this would have been stated at 1.2 crore. Yeah. Now, goodwill will change to 70 lakhs. Why? Because now the value of patent has increased by 50 lakhs. Okay. So now what will be the value of goodwill? 70 lakhs. And the same amount will change over here. This will also become 70 lakhs. Correct. Patent was shown at 1 crore earlier, on which some amortization would have been charged. What was the amortization earlier? 83,333. So the net balance of patent became 99.16 lakhs. Fine. So I've taken the gross amount. As I told you, I did not compute the amortization. Now the patent would be 1.5 crore. But we will consider this 1.5 crore amount from the date of acquisition. And we will charge amortization from the date of acquisition. In which case, its carrying amount will become 1.48 crore. It will become 1.48 crore. And similarly, its amortization, which was 83,000 earlier, that will change to 1,25,000 now. Of course, all of these numbers will then flow in the next financial year. What we have tried to see is, how the comparative amounts have changed. And all of these computations are sold in the presentation. So you can also compute all of these numbers on your own later on. I'm not getting onto the computation right now. You can do that computation later on. All right. All of you clear on this? Any questions, any doubts in case you have on this, please let me know. All of you clear on this? So what you should do is you should mark illustration number 22 as your homework. And I think this is page number 13.55. Small, easy illustration, good for your practice. Huh? You can just note down this for your homework. And now we'll move on to one more illustration. This is page 13.56, illustration 23. So let's move on to this illustration now. Yeah. Okay. ABC Limited acquires XYZ in a business combination on 15th of January 2000 X1. Few days before the date of acquisition, one of XYZ's customers had claimed that certain amounts were due by XYZ Limited under penalty clauses for completion delays included in the contract. ABC evaluates the dispute based on the information available at the date of acquisition and concludes that XYZ was responsible for at least some of the delays in completing the contract. Based on the evaluation, ABC Limited recognizes 1 crore towards this liability, which is its best estimate of fair value of liability of the customer based on the information available on the date of acquisition. Okay, so that means some information was available on the basis of which fair value of liability was ascertained at 1 crore. In October 2000 X1, means after the end of the financial year, when the provisional accounting was done, but within the measurement period, customer presents additional information as per which ABC concludes the fair value of liability, which it estimated as 1 crore on the date of acquisition, should be 2 crore on the date of acquisition, or should have been 2 crore on the date of acquisition. ABC Limited continues to receive and evaluate information related to the claim even after October 2000 X1. Its evaluation does not change till February 2000 X2. Okay, that is after the measurement period, when it concludes that the fair value of the liability for the claim at the date of acquisition is 1.9 crore. ABC Limited determines that the amount that would be recognized with respect to the claim under Ind AS 37 as at February 2000 X2 is 2.2 crore. Okay, so now in February they have settled this amount at 2.2. Settled means in terms of their assessment. How should the adjustment to the provisional accounts be made? So let me just tell you, in the first year, I am calling first year as the year in which provisional accounting is done. Liability is recorded at 1 crore. Okay. Subsequently, we can see 3 values coming in. 2 crore in October, then till February end it was 1.9, and finally at the February end it settled at 2.2. Yes. Can you tell me how should this accounting be done? I am waiting for a response. Quickly, start sharing your thoughts without reading the solution from the study material. Quickly, tell me what should be the answer over here. Yes. Quickly, huh, all of you? I'm waiting for a response. Yeah, you need to be quick, huh, please. What should be the response? What will be the answer over here? Tell me, what should be the answer? How will you deal with this situation? Yes, all of you, quickly. I'm waiting for responses. How will you deal with this recognition of amount of liability? Should we go to the solution then? Yes. All right. In the consolidated financial statements for the year ended 31st March X1, the value recorded was 1 crore. Okay. Which year was this? First year. As at 31st March X1. Now we move on to next year. As at 31st March X2. And in this year, we will also give these as the comparatives. Okay. When the customer presents additional information, increment liability will be adjusted as part of acquisition accounting because it arises within the measurement period. In its financial statements for the year ending 31st March 2000 X2, ABC will disclose the amounts and explanation of the adjustments made to provisional values. Therefore, it will disclose that comparative information for the year 31st March X1 is adjusted retrospectively to increase the value of liability from 1 crore to 2 crore, resulting in a corresponding increase in goodwill. So when the value of liability will increase, what will happen? Goodwill will also increase. Correct? Yep. So now in this year, this will become 2 crore. And corresponding to this, goodwill will also increase. Yeah? Okay. Information resulting in the decrease in estimated fair value of the liability for the claim in February 2000 X2 was obtained after the measurement period. Now the change from 1 crore to 2 crore amounting to 1 crore means the change of 1 crore is within the measurement period. So that is acceptable as per the requirements of Ind AS 103. But the change which says that this 2 crore will become 1.9 or 2.2, that arises after measurement period. Okay. Accordingly, the decrease is not recognized as an adjustment to the acquisition accounting. If the amount determined in accordance with Ind AS 37 subsequently exceeds previous estimate of fair value of liability, then ABC recognizes the increase in liability as the change has occurred after the measurement period. Increase in liability will be recognized in P&L. Now, when we say that this 2 crore becomes 2.2 crore. Okay. Now, for this change from 1 crore to 2 crore, what do? We call this to be an adjustment to PPA, and therefore value of goodwill gets impacted. Means change doesn't go to P&L. Yeah. But when we say that the liability has increased now from 2 to 2.2, then we'll not say it's business combination accounting. Then we'll not consider this amount to be changing because of business combination. No. We'll just say it's an increase in liability which has happened, for which this impact will go to P&L. Okay, yeah. And what is this impact? 0.2 crore. This will go to P&L. Clear on this point? Yeah, all of you clear on this point? Any questions, any doubts in case you have on this, please let me know. Are you clear on this point? This is again considered to be a very important clause in case of business combinations, and you may be thinking, sir, do these things really happen? Are these practically possible, or are these theoretical? That we do this provisional accounting and then we do this retrospective adjustments. All of these are very common. In fact, in case of business combinations, something which you very commonly see is provisional accounting. If an entity is not doing provisional accounting, that is very uncommon. Okay. Yeah. Any questions, any doubts in case you have, please let me know. Anjali is asking, sir, fair value at the time of reporting will be taken? Of course, because whatever is the fair value at the time of reporting, that will have to be finalized, but it will have to pass through two stages. One, up to the end of measurement period, whatever is the change, you will take it to PPX. Yeah, and anything which arises after that date will not be a part of PPA, that will be separate from PPA. That is how you need to consider this. Okay, clear? Yeah. Preeti is asking, sir, this 20 lakhs, 0.2 crore will be the loss of next year and the earlier figures are not restated? No. Because this is not a part of PP exercise. Okay, clear? Nanda Usha is asking, sir, 20 lakhs is recognized in P&L? Yes. Because it's a change in liability which has happened subsequently. That is the assumption taken. And that's the assumption taken because that is arising after the measurement period. So the information can keep coming in relation to any asset or liability. If that information keeps coming every now and then, so should we keep saying that it's arising because of the previous periods or because of the information which existed and got missed? Not really. So we'll have to just again analyze whether that was missing information or that was additional information which has been received later on. Okay. Yeah. So should we move now? Okay, so now we'll move on to next discussion around common control transactions. Common control transactions. So you can say that in a way we have completed our discussion on business combinations by now. Okay, so if I make a statement that we are done with business combinations, I will not be wrong. We are largely done with business combinations. Means Ind AS 103 is largely covered by us. And the next topic that I'm just starting off right now is again not different in terms of the conceptual requirements that we have discussed. But yes, in terms of accounting requirements, some new things will have to be considered by us. Let's understand what do I mean by this. Common control business combination transaction. So far, all the transactions that we have discussed in relation to business combinations were assumed to be not under common control. I'm just repeating my point. So far, entire discussion that we have had, wherein we discussed about various transactions of business combinations, we assume everywhere, okay? We were assuming, and I never told you. So you don't worry. So you may be thinking, sir, if we assume, what if we didn't assume? That is something we are discussing now. So I'm saying we assume that all such business combination transactions were not having common control. And let's now quickly try to understand what do we mean by common control. Okay. Say there is a shareholder A which has got three entities, B, C, D. Below C, there are two entities, E and F. Below F, again, there are two entities, G and H. Below D, there are two entities, I and J. Below J, there are three entities, K, L, M. And below B, there is one entity, N. Yeah. I'm not sure whether you have seen such a complex structure or not, or such a type of structure of the group or not, but these group structures are also very common. If you look at large groups, they have got multiple entities. So if you look at the groups like Tata, for example, Reliance, if you look at the groups like Network 18, etc., there are so many companies within their group. They have so many companies within their group. And on the top of them, generally, there is one entity which controls all of those companies. On the top of them, there is generally one company which controls all of them. Yeah. Now, what do we mean by common control? And how is it different from any other business combination that we've discussed? Let's suppose Z comes and buys N from B. Let's suppose Z comes and buys N from B. Yeah. In this case, when Z buys N, Z is not a part of this group anywhere. Can you see Z to be a part of this group? Not at all. Z is not a part of this group at all. But let's suppose E moves from C to this place. Okay. Let's suppose E moves from C to D. Or let's suppose E moves from C to K. Now in this case, when E is moving from C to K or C to D or to any other place within the group, what do you see? That prior to acquisition of E and after the acquisition of E, the control or the ultimate control over E remained same. Means the shareholder which controlled E prior to its acquisition and after its acquisition remained same. And this control was not transitory. Transitory means when A used to control E, this was for a long period of time. And after E is acquired by D or K, when this will be controlled by A, this will again not be for small period of time. This is not transitory. This is not for small period. When we have such type of situation wherein the control on the entity which is acquired by another entity remains common, that is called as common control business combination transaction. Unlike this one, wherein prior to acquisition of N, it was controlled by A, and after its acquisition, it will be controlled by Z. And by control, you may be thinking, but sir, is E not controlled by C? How can you say E is controlled by A? So we are talking about ultimate party which is controlling. A is controlling C, C is controlling E. So ultimately, E is controlled by A only. Yeah, so we need to look at the company or the party or the shareholder who is controlling it ultimately. And it's not necessary that A should be a company. A can be a shareholder. A can be a person also. A can be an individual also. Clear on this? Yeah? Clear on this? Such type of changes or acquisitions which take place within the group, they will also require control to be passed on. One thing is very clear, that for business combination, two ingredients have to be there. One is business, second is control. So when we talk about this situation, even in this situation, control has to be transferred. If the control doesn't get transferred, then it's not a business combination. But when we say control is transferred from C to D or C to K. But the ultimate control remained with A. And business also got transferred. Okay. Now, for these type of common control business combination transactions, accounting requirements are different from what we have discussed so far. So far, we have discussed that accounting requirements will require PPA to be done. Purchase consideration less fair value of net assets will result in goodwill. That will not be the case. In case of common control transactions, there will never be a goodwill. Standard says there will never be a goodwill in case of common control transactions. There will not be a fair valuation of assets and liabilities of E. Yeah. So that different accounting will understand in the next session, because I think we are moving towards the end of the session now. And it will not be possible for us to just start and then end it. So better I pick up the accounting requirement in the next session only. If you have any questions, any doubts around the structuring, around this concept of common control, how a particular transaction will be considered to be a common control, please let me. Yes, quickly. Yes, quickly. Any questions, any doubts in case you have? Any questions, any doubts? No? Okay, so then what we can do is we can just close our discussion over here. In the next session, we'll continue with common control transactions, and we'll also start practicing more questions on business combinations, because most likely we'll wrap up business combinations in the next session after practicing some questions around it. All right, yeah, and then we'll begin with consolidated financial statements. Okay, yeah. So with this, we can just conclude our session now. Thanks to all of you once again for your time and for your wonderful participation. Thanks so much.